Morning, everybody. Morning, Zeppo.
Greg, how's it?
Good to have you by my side today. Certainly a very different location today to frame our podcast. Typically, you'd see a podcast hosted in an office environment. Isn't it good to be out of the office?
Definitely is. We're out of office, but in the office of where we're going to be speaking to today.
Agreed, Zeppo. We have some great contributors today. We've got Jason McCormick from Exemplar and McCormick Developments. Certainly a trusted and respected voice in our industry. I have a couple of questions for Jason that will shed a bit more light on rural and community retail development and investment. And then secondly, also privileged to have Rambhai as a portfolio manager with Community Property Fund, who will also share similar insights as to why institutional investment in the rural and community space has been so rewarding, both commercially and in terms of community upliftment. So Zeppo, where do we find ourselves today? We're at the Pick and Pay in eMalahleni. This is a property that you've brought to market with us. eMalahleni, very much a secondary town, not getting as much of a spotlight as the likes of Johannesburg, Cape Town and Durban. But make no mistake, it's a town that is enjoying resilient economic activity. Mining and energy certainly underpin what we see here as a community economic driver. We've got long-established residential neighborhoods. We've got local government support. We've got local business growth and development. And all of that requires retail service and retail support. A couple of key things I think Zeppo will pick up on during the course of our conversation today, and similarly to be, I think, further developed by Jason and andSmital in their responses to us. The issues of the rural retail segment being premised on necessity spending as opposed to discretionary spending. And what I mean by that is discretionary spending is typically what I like, but not what I need. Luxury spend. It is typically influenced by what's happening in the economy. If the economy is not strong, I tend to reduce my discretionary spend. Whereas in a lot of these community rural developments, these retail developments, it's necessity-based. Sure. I am here to spend on groceries. I'm here to spend on medical care, clinics.
Essentials.
Essentials, 100% Zeppo. So less affected by economic shocks. One of the obvious economic shocks we're experiencing at the moment is the rise in petrol. What do you think about that? The increase in petrol prices, does that affect spending patterns? Proximity versus and convenience versus a bigger mall, for example?
No, Greg, you've actually hit the nail on the head on a lot of points which you've mentioned. And as to why we're here today, because this type of asset we add, it's very defensive to a lot of the outside or macro effects. Here we smacked right in the middle of eMalahleni Wheatbank. As you mentioned, there's a lot of mining operations around. And in those same operations, a lot of the people that work there are actually based in this neighborhood. Similar to the sites where we are, a lot of the workers in the Pick and Pay and on the sites, even the businesses that are operating in the sites, they are people who are based in the community. So that just gives you a better understanding of the dynamics and the fundamentals of the sites, that it's not just investors or businesses who are taking money outside of the community, but it's people who are based in the community. They are part of the community, and whatever the operations they are based on the community.
I think that's an important point, certainly, Zeppo. I mean, this is a franchise store. The franchisee typically is immersed, embedded in the community. He's a member of the community. He's got a vested interest in the success of the retail operation. Oftentimes, the franchisee will also tailor-make the product offering to talk to his community needs. And that tends to create and solicit loyalty from the community. So there's more regular visits, greater footfall. This particular center has all of those essential necessity spending elements. You've got a strong grocer. We've got a pharmacy, a clinic. Talk a bit about the center and its tenant profile in terms of attracting footfall to the facility.
As you noticed that when we came in, it was around 9 in the morning. Already, there were a lot of cars parked outside. That just shows you how essential this property is to the community. We're directly opposite a church. 500 meters away is the main hospital and a police station. As we came in 9 a.m. today to the site, it was already full. Cars outside, foot traffic, people walking in, either grabbing breakfast for work or maybe preparing for lunch later. We're 500 meters away from the main hospital, 500 meters away from the police station. You can literally see the freeway from where we are. This is a very focused and community-based center. I chuckled with myself a bit earlier because when I walked in, there was a lady buying Fred Cook and some Russians outside. It just shows you, going back to the point of, as this is a franchise store, the franchisee can tailor make most of the things based on what the community needs, based on the community's affordability. And this is a middle LSM community. You get, as we mentioned before, you get guys working in the mines and in the anchor industries in the area. It just shows you the fundamentals of the sites where we are today.
The conversation, I think, has shifted away from rural versus urban development of retail facilities, and rather more to the point, where is retail underserviced? Now, we've certainly seen in these secondary towns that population has grown, spending capacity has grown, but they remain largely underserviced. And that's where you tended to have a spend leakage, that spend outside of the community, that have to go to an urban location, a bigger mall. So very accomplished developers and institutional capital, likes of Jason McCormick and Exemplar, and of course andSmital, Rambhai and Community Property Fund, have realized there's an intersection, a basis of which, both on commercial and community upliftment, they see an advantage in their investment thesis. And more of this capital is flowing into secondary markets like this to service the underserviced communities. And that perhaps can lead into some of the questions that we have today for both Jason and andSmital, to talk about their performance over the last year, over the last 30 years, and why they continue to see investment in rural and community as such a rewarding initiative for those funds.
Just on that point, I myself growing up, we used to travel about 40, 50 Ks at the end of the month just to get groceries with my family. That has completely changed over the years because of that institutional capital and the investors actually seeing the leakage or the opportunity in between, that you don't need to travel for that long in order to get groceries for your family or even to look for jobs or employment. Because if you're looking at these developments and the institutional capital actually coming into rural and retail investments, it creates a lot of job opportunities. It also creates growth within those communities, because you find that a lot of the people that work in those centers, not just when the centers are fully built, but from the beginning, from the planning stage to construction, and obviously when the centers are operational and the stores are in, your Pick and Pays, your pharmacies, your clinics, it gives the community a sense of pride in that specific property or that site which they're working on. So it just shows the importance of these kind of centers And it shows the importance of the institutional capital, not just staying in your Sandtons, your Pretorians, but actually going into the communities where it makes much or great impact to the people who stay there.
Zeppo, I think it's a good time to perhaps talk to our guest contributors today with Jason McCormick and andSmital Rambhai. As much as we talk about the impact on the community, creating growth nodes, economic nodes, it's well reported that both of Exemplar and Community Property Fund have enjoyed great returns on their investment in rural retail and community retail. Exemplar just recently reported a 15.3% return year on year on their distributions. Their portfolio of 28 properties is valued at just over 11 billion rand. And if I look at McCormick Development, who feeds into Exemplar, I mean, they've developed 88 centres. And I think you and I were discussing this on the way here earlier. I think they've got 10 properties either currently being worked on or in pipeline. So they're keeping themselves busy. And that means that the demand for rural and community retail remains ever evident. And they're talking to that requirement. If I look at andSmital and Community Property Fund, their valuation or their portfolio value now sits at just over 9 billion. And they've reported a compound growth over the last 30 years of on average just short of 13%. It's unbelievable. andSmital was saying in one of his interviews, the other thing that he reflected on was that when he started 13 years ago, the local community represented about 50% of those that were employed in their centres. That's up to 84%. Talking to your comment earlier about how these community centres are catalysts to community investment, upliftment, employment, etc., etc. So I think it'll be a wonderful opportunity for you and I to put some questions now
over to
both Jason and andSmital.
Definitely.
Thanks, Zeppo.
Yeah.
Jason, it's wonderful to have you on the podcast today as one of our contributors. Certainly, your insights and thought leadership are always well respected. Zeppo and I have spoken a bit about what you've done, some of your recent performance results. But I want to walk back a little bit. The 4 decades that McCormick Development has been in rural and community retail, very much underserviced markets. I'd love to know what you learnt. What was the foundation that you took out of this work in areas that were largely ignored by many other institutions and developers up to now?
I was extremely fortunate to grow up alongside my dad building the company from early 1983. I was 5 years old when he started his first developments. And 1987, I went to the first opening of Giyani Plaza in Gazankulu. And from that very day, saw the elation on the local communities that he had brought town to the townships, to the rural areas, and was bringing convenience and first world, first class amenities to the people, the sense of pride that they had in their then homelands, and ultimately then later into the townships, was just something that you cannot explain. And you know, we come from very, very humble backgrounds. You know, we didn't have any money growing up, so my dad literally built this thing from the ground up. For his first development was a single shop, and you know, certainly that's one thing that we've never lost is the humility, the understanding that you know, the importance of the work that we're doing in these very impoverished communities, these very destitute, a lot of them communities, and growing up alongside the people, with the people, and seeing how we've been able to develop and better their lots of life, made it so much bigger than just the financial, the capitalistic side of the business, when really we are driving this change for good in bringing assets that fundamentally change the social fabric of the communities in which we develop for the better.
Jason, another one of the topics that we've spoken to during our podcast is the fundamental of underserviced retail. And that is very much one of your prevailing thesis that governs what you do in the marketplace, underserviced retail and servicing that in the communities. So what does that look like on the ground, Jason? What does that look like in terms of a community before your asset is developed and launched to the market, and what that community looks after your asset is launched to the market?
Indeed, underserviced retail is our entire thesis. We look to go to areas that are completely underserviced and bring first world dignified developments that really bring a new layer of hope to the communities and and fundamentally change the communities. What a community looks like before and after. If you cannot explain the fundamental change. And I, having grown up alongside my dad in his earliest developments in places like Acornhoek and then in early 1990s and Jane First, there were literally grazing land, a couple of goats and nothing else. And you see how that kind of gravity that those early developments created to bring government services and other services and informal trade all around, and really became the nexus of community. And so ultimately they became the village squares of old, these shopping centers where they became the magnet around which the entire community is agglomerated. And it's incredible to look at places. Jane Firs is a great example. You look at how Jane Firs has developed rather than Glen Cowie, where he was originally going to do the development, but then wasn't allowed to by the chief at the time. And you look at how Jane Firs has developed as a direct consequence of that plaza, compared to Glen Cowie, it really hasn't much other than a government hospital in the same amount of time. So there's no doubt that the knock-on multiplier effect of economic development around these malls, around these shopping centers, particularly the rural ones, have a massive impact. Particularly when you're bringing in critical infrastructure, they fundamentally change the communities for good going forward.
We're keeping you busy today, Jason. Another question for you to consider. There is still some reticence at times in institutional capital finding its way into these underserviced markets. Why do you think that is? And do you think that will change, or is it changing?
Listen, in terms of institutional capital, today is a lot more than there used to be. I remember when I first started in the business, we were doing developments and we were more a development company. We were selling developments after we were finished with them. And we were selling them at 13.5%, 14% yields. Because there was just very, very little institutional capital chasing developments in these areas. That thankfully has changed. I always joke and say that when I first started, we couldn't buy a Mr. Price into any of our shopping centers for zero rent. They just saw no opportunity. But as South Africa has kind of normalized and the median incomes in these areas has risen, and we've now got this as being the main market where the bulk of spending power now sits. We've seen a massive amount of institutional interest coming in, and there's a lot of institutions that are looking to get involved. A lot of them looking from over their white picket fences, looking and wondering how to get involved. But for those that have been in for the longest time, the likes of ourselves, the likes of ShopRite, Pepkor, the proof of the pudding's in the eating, and you're just seeing how well those that are already entrenched in these environments have been doing financially as a consequence of their deep embeddedness into these very highly populated environments.
Jason, in the podcast, Zeppo and I actually reflected on a conversation today in the car where we were talking about McCormick having 88 retail sites that they've completed development on, and that there's a pipeline of up to 10 currently being worked on. And I see in your LinkedIn and other posts on social media, you're constantly in the air flying from one location to the other. And it's one of the reasons we couldn't get you in the room today, just your commitment to a lot of these rollouts in your pipeline. With 28 centers already up listed on Exemplar, tell me, is it your strategy to continue to develop, or is there a different strategy going forward, perhaps a hold and sweat of the asset? Is there a pivot that we're expecting, or is it much of the same?
28 assets. No, we've got currently 40 assets under ownership and management. If you include the assets owned by McCormick that sit outside of Exemplar, we have another further 4 assets that are in the ground that will open this year. And another 2 that are in the ground at the moment that will open next year. Cumulatively, those 6 will add another 153,000 square meters. We will start another 3 developments this year that will add another 53,000 meters to the portfolio. By the end of next year, we anticipate having between 51 and 53 assets within the McCormick and Exemplar portfolios. So yes, it is more of the same, but the depth of what we are doing and the breadth of how we are doing it is going to be fundamentally changed over the next couple of years as we look at how all the digital online and everything like that is coming at us. You're going to see a massive change in how we do business and the way we do business. And so certainly from my side, I don't want to be saying too much, letting on in too much, but we are doubling down. We've got an incredible pipeline of probably over 40 schemes now secured in our pipeline. So we are definitely for the next 10 years going to be very busy building new developments, as well as continuing to refine our existing portfolio to future-proof them for the more online world that is coming at us. And it's an exciting time because with the threat of online, with the threat of all this delivery and everything else that's coming at us, it presents a huge amount of opportunity. And I'm certainly very excited about what the future holds, and I'm having a lot of fun crafting the strategy for it. Thanks.
Jason, I have to thank you for your time. I know you and I really struggled to get that time in your diary. You had shown me what your diary looked like, and the privilege of having you in this podcast cannot be overstated. Good luck with everything, Exemplar and McCormick Development, and the great work you continue to do in these underserviced rural and community areas.
Thanks so much, Greg, for having me on the podcast. Enjoyed it and wish you all the best with the auction and all your work going forward.
This morning, it gives me great pleasure to introduce as our guest speaker, Smital Rambhai.
I work for Future Growth Asset Management. I head up the properties division where, we currently run a fund which Greg mentioned invests into shopping centers in townships and rural areas. We invest into shopping centers directly on behalf of our pension fund clients. It's been one of the most defensive sectors in the property space. We've got properties in 8 of the 9 provinces. 80% of all our employment in our shopping centers are from the local community, and that's how we obviously get good support from the community in our centers.
Smital, thank you for joining us today. We know about your work and how passionate you are about the communities that you operate in, and we've got a couple of questions for you today. First one, how does Future Growth think about property investing as an investment vehicle beyond just the returns that we see on paper?
Thank you for having me on your show. So our philosophy at Future Growth has always been that commercial returns on investments go hand in hand with social impact. And, again, we strongly believe that those two go hand in hand. If we look at just when I talk about social impact, I'm talking about creating jobs during the construction phase when you're developing new properties. And obviously post-construction, there's permanent employment created in those properties, whether it's a retail shopping center, office, industrial, jobs are being created on a permanent basis. Now, the other aspect is when we look at properties that, how can we bring essential goods and services closer to communities? In our case, where we operate in the township and rural economy, that is a real tangible thing where people are seeing a considerable saving in terms of transport costs because of those services and goods being closer, but it could hold the same for urban areas. Then when we look at the properties that we invest in and enhance value on, or if we develop a new property, remember that there's a rates pool that gets created, and the municipality benefits because they can then further bulk up infrastructure in the area and improve services and delivery for everyone. And then lastly, on that question, I just want to give you an example. We own Bridge City Shopping Centre in KwaMashu. We bought it on a forward purchase agreement from a developer back in 2010. And that shopping centre was a catalyst for further development in the KwaMashu area. So what we saw subsequent to the development being completed, Prasa built a railway station underneath the shopping centre that connects into the shopping centre. And then they've also, what happened in that node is a regional magistrates court was open, then a government hospital opened up, which was about a 500-bed hospital called Dr. Pixley. And now we're seeing a lot of affordable housing being developed. So, property investment can be a catalyst for economic growth in the country.
No, thank you for that, Smittel. And this question is actually it's a bit personal for me. And I wanted to pose it to you. Is there a gap between where private capital wants to play and where the real opportunity is? As we are out in eMalahleni today, this is a secondary market compared to your Pretorias and your CPDs. And with your experience in terms of working with secondary markets, rural and township markets, where do you see the opportunities, or where do you see the gaps between institutional capital and where further growth is within the secondary markets?
It's great to hear that you guys are in eMalahleni, because in fact our fund actually owns a shopping center in that area called KG Mall, which is just probably around the corner from you guys are sitting right now. But just for to answer your question around, is there a gap in terms of private capital investing in the secondary markets, in the rural areas in which we play? I don't think it's a lack of private and institutional capital chasing those areas. I think it boils down to decades of experience. If you look at all the key players in the market, including ourselves, you look at Exemplar, Jason McCormick and his team. You look at Twin City, Moorman, the Moorman Property Group. These are all companies that have been playing in this space for decades, and I think the complexity lies in the fact that in the rural parts or secondary towns, infrastructure is not the greatest. So, you need to understand the landscape very well, and design your shopping centers accordingly. So, I think it's stuff that gets taken for granted in the urban areas where, things kind of work. You've got to factor in sewage, treatment plants. You've got to factor in, access to water, as well as electricity. So it does scare off some people, but again, I think it's not a lack of trying from private capital to go there. I think it's just that the experience lies with a handful of players in the market.
No, super, Smittel. Thank you for that. And last question. What's a bet you'd make on SA property right now that most people think wouldn't work or could be riskier?
No, that's a very good question. I think, as I say, no risk, no reward. I think offices has obviously been kind of negatively tainted post-COVID, where people started working from home. What we've been noticing, there's been a massive uptick in Cape Town, across the country, where people are returning back to office. I think, as human beings, we are social creatures, so we need human interaction. So I would say yes, offices, whilst risky, I think if you choose the right nodes and take the risk, I think there's definitely good opportunity there. I mean, I look around in Cape Town and, just looking at office space, if you're looking for large office space in excess of 800 square meters, you just can't find it for a large organization. So I definitely think there's development opportunity in the Western Cape on that front. Student housing, again, the backlog is still there for affordable student housing across the country. And then I think retirement villages is something that's still a newish concept to a lot of property players, especially institutional capital. And, if you look at South Africa's aging population, in that mid-tier range, I do believe there's a strong justification for investment in that sector. But I think it boils down to finding the right partner with proper experience in that space.
Smittel, one last question to you. Again, thank you for your time. I know that you've spent the last 3 days up in Sun City at the Batseta Pension Conference, the Pension Fund Conference. I know that the delegates, the intention was to talk about the power of 1 degree, and specifically to unlock, in an exploratory framework, how pension fund capital could be deployed to change the growth trajectory on the African continent. So hot off the press, perhaps, with you, Smittel, some of your thoughts coming out of that conference. How can pension fund money be deployed for inclusive growth on the continent, exponential growth on the continent. We'd love to hear your insights. Thanks, Mattel.
Thanks, Greg, for that question. Now, the conference was definitely very interesting. It was nice connecting again with peers in the industry, our clients. But I want to take you back to 2024, where a survey was conducted around how big the South African pension fund market was. And at that time, it was around 4.8 trillion rand. That's obviously grown over the last 2 years, given how strong markets have been. But just contextualize that number, 4.8 trillion rand. Now, in that survey, it was kind of found that pension funds have generally allocated, plus minus between 2 and 3% of that 4.8 trillion rand towards alternative investments. And just for your viewers to understand what alternative investments are, it's private equity, it's private debt, private real estate, so anything that's not listed on the stock exchange, or any infrastructure that's not on the stock exchange. And if you just think about it, it's 2 to 3%, whereas our global peers in around the world allocate between 18 to 20% towards the sector. And what happened at the conference is that the conversation has actually moved away from raising capital to actually deploying it. And if you just think about Africa, if you think about the South African market alone, it holds significant pools of institutional capital. But I think the key conversation was around turning that capital into bankable and investable opportunities, and that remains a constraint. Infrastructure is increasingly central. It offers good long-term returns. There's income, they're income-generating assets, and they're also aligned with real economic needs, to make a country grow, to add value to the GDP of that country. But again, it boils down to how do we unlock that capital that's available? Because it requires, again, good structuring. It requires strong governance, great collaboration, to make those projects work. So I think that is the key. And I think the key theme is can you just imagine if you allocated just 1% of the 4.8 trillion rand into the rest of Africa, that will, it's a significant capital to deploy across the continent.
Smital, thank you for your time today, and we hope to chat to you soon. Cheers.
Thank you very much.
Okay, well, to our audience, to our contributors, to you, Zeppo, it was great having you alongside me. I think you've seen a very granular view of this Auction Talk episode, this podcast, as we go out into the industry. We work from the offices and the sites that we are taking to market. It's not an asset manager view sitting in an office. We are here where people live, work, and play.
Boots on the ground.
Boots on the ground, warts and all. So unashamedly, as raw as it could be. And I think it gives a new perspective on thought leadership and insights about what's happening in our industry and in the properties that we take into market.
No, definitely, Greg. And thank you to the heavyweights that joined us today. Great insights. They gave us their honest thoughts in the topic that we had today. And thank you very much to the gentlemen. And thank you guys for tuning in with us.
It was a privilege to present to everybody and spend time with you, Zeppo. Thank you. And on this, we close.